Most people only think about their credit score when they apply for a loan or a credit card. But by then, it is often too late. A credit score is a quiet number that follows you for years, shaping decisions you may not even realize are happening. It can decide what you pay for a home, a car, or even your insurance. Understanding how it really works is one of the most useful financial habits you can build. A credit score is a 3-digit number that summarizes how risky you appear to lenders. It is built from your borrowing history, your repayment behavior, and how you use credit over time. The score is not a judgment of you as a person. It is simply a prediction of how likely you are to repay future debt based on how you have handled past debt. Lenders use it to decide quickly. This score matters because lenders use it to decide two things. First, whether to lend to you at all. Second, what interest rate to offer if they do. A higher score usually means more options and lower rates. A lower score may mean fewer approvals and much higher costs. Over a lifetime, the difference between a good and bad score can be worth tens of thousands of dollars. To understand how the score is built, think of it as a recipe with a few main ingredients. The biggest ingredient is your payment history. Then comes how much of your available credit you are using. Then the length of your credit history. After that, the mix of credit types you have. And finally, how often you apply for new credit. Each ingredient contributes a different weight. Let us look at a simple example. Imagine two people with the same income and the same job. One person pays every bill on time and keeps balances low. The other person occasionally misses payments and often runs cards near the limit. Over time, their scores will diverge sharply. The first person will be offered better rates and bigger limits. The second person will quietly pay more for the exact same products. A common mistake beginners make is thinking that not using credit at all is the safest choice. But credit scores are built on demonstrated behavior. If lenders have no information about how you handle credit, they cannot trust you with larger amounts. Avoiding credit completely can leave you with a thin or invisible profile, which can make borrowing harder later, even if you have always been responsible with money. There is also a hidden risk most people overlook. Even one missed payment can leave a mark that lasts for years. Late payments, defaults, and accounts sent to collections can stay on your record for a long time. A single bad month can damage a score that you spent years building. That is why protecting your payment history is far more important than chasing small score-boosting tricks. A useful metaphor is to think of your credit score like your reputation in a small town. It takes years to build, only seconds to damage, and people you have never met still hear about it. Lenders, landlords, and sometimes employers can look up that reputation before deciding to work with you. The actions you take today quietly shape how strangers will treat your applications tomorrow. A second key idea is credit utilization. This is the percentage of your available credit that you are actively using. If your total limit across cards is $10,000 and your balance is $1,000, your utilization is 10%. If your balance is $7,000, your utilization is 70%. High utilization signals stress and pushes scores down, even if you pay everything on time. A practical example helps. Imagine two people with the same single credit card and a $5,000 limit. One person keeps their balance around $500. The other person regularly runs their balance near $4,500. Even if both pay every month, their utilization is very different. Over time, the high utilization profile usually scores lower and receives less favorable offers. Beginners often misunderstand how length of credit history affects the score. Closing your oldest credit card might feel like a clean financial decision. But it can shorten the average age of your credit history and lower your score. Sometimes the smarter move is to keep an old account open with light, occasional use. Age of accounts is something only patience can build. You cannot fast forward it. There is also a psychology angle. People often delay checking their score because they are afraid of bad news. But not knowing your score does not protect you from its effects. Checking your own score regularly does not damage it. Avoiding it only delays the moment you have to deal with it. Awareness is one of the cheapest tools you have in personal finance. A simple practical rule can protect your score in most situations. Pay every bill on time, even if you can only pay the minimum that month. Try to keep your overall credit utilization on the lower side, and avoid opening many new credit accounts in a short period. These 3 habits alone protect the largest ingredients that go into a healthy score over the long term. There are a few things to avoid. Do not apply for many credit products in a short time, because each application can leave a small mark on your record. Do not max out cards just because the limit is there. And do not ignore old debts that are sitting in collections. Even small forgotten balances can quietly hold your score back for years if they remain unresolved. A better habit is to automate everything you reasonably can. Automatic payments on at least the minimum amount can prevent the most common cause of score damage, which is late payments. Setting calendar reminders for due dates is another safety net. Small systems like these protect your score without requiring willpower. Most credit problems do not come from greed. They come from forgetting. Over the long term, your credit score quietly shapes major life decisions. A strong score can help you qualify for a home loan with a lower interest rate, which can save you a significant amount over many years. A weak score can lock you out of options or force you to accept worse terms. The score is silent, but its effect on your wallet is loud over time. So here is the short version. Your credit score is a 3-digit prediction of how likely you are to repay future debt. It is built mostly on your payment history and how much of your available credit you use. Length of history, mix of credit, and recent applications also matter. The score is silent in daily life, but it appears every time you ask to borrow. If you want a strong score, the rules are simple but require time. Pay on time, every time. Keep your utilization low. Do not close your oldest accounts without thinking carefully. Avoid opening too many new ones at once. And check your reports for errors. None of this is dramatic. None of it requires advanced finance knowledge. But done consistently, it quietly compounds into one of the most valuable invisible assets you can own.